Hey everyone, thanks for joining another learning session. If you watched our first one, Introduction to Spreads, I mentioned that we would be going through in more detail another spread learning session here into the carry and the inverse. So that's what today's video is. Call it a follow-up to the intro one or the secondary in-depth exploration of basically two main states of spread. So we're going to dive into the carry and the inverse. What do they mean? Why they matter to us as we're making our marketing decisions, and how we're taking an outlook of what the market is going to be for a whole year or even out a couple of years. So let's get into it. So firstly, as I mentioned in the intro videos, is a future spread tells us so much about what the fundamental balance of supply and demand that's occurring in the physical market as well. So understanding whether the market is in a carry or an inverse is really essential to interpreting what these price signals are going to be, so we make the sound marketing decision for whether it's selling something in the nearby, if we're looking to hold something longer term, or just what the overall market is going to be, even when you get into that new crop, old crop spread as well. So firstly, a carry is a negative spread. So the market is offering additional value, or really is incentivizing you to carry inventory from one delivery period to the next. For example, on corn, you would have like the December to the March. So in a carry, it's usually considered a normal market. The technical term is contango. An inverse is where the spread is positive. So that is the market willing to pay more now for your product than they would in the future. So this is a signal of the market usually being short and is urgent to get supply to cover off what their needs are. An inverter market is usually non-normal, and the technical term is backwardation. So what is a carry? So the carry is the price difference between the spot or the nearby futures price and a deferred futures price. So it's the price less the deferred price. So when the value is negative, that market is said to be in a carry. And the carry represents the financial incentive that the market is willing to pay participants to store or hold their physical product from the nearby to a later date. A market that's in carry is generally considered a healthy one, where you can say that the supply and demand are relatively well balanced to what the current needs are, to even slightly oversupplied though. So what the carry is composed of is the real costs that are incurred by either a farmer or a commercial, a buyer, to hold the product. So that is your storage, your insurance, and your opportunity costs. So essentially your financing charges that you'll incur. So when you think about like on the financing charges, it would be if you had gotten the cash up front and you could have put it in a risk-free investment, right? Rather than not getting the cash and carrying the product out for 3 months. So that's where that financing opportunity cost type comes from. And of course, the storage is going to be your warehouse or elevator fees, or even your on-farm cost of storage as well, right? Insurance is coverage against loss, damage, or deteriorating grades of it. And as I said, the financing is that interest cost of capital that you would have tied up in that inventory that you're not getting cash flow for. So one of the ones that you might hear spoken about a lot in the market as well is full carry. So that's when the spread widens to the full cost, that is your full storage, insurance, and financing. So really what we have here is generally, and we clarify generally, that ag markets won't see the spreads get to a full carry. But that doesn't mean that they never do. Usually it gets to something around like 90%. But you may also hear people talk about full financial carry, which is just the financial side to carry the product. It's keeping outside of like the storage costs and your insurance. So kind of the market dynamics of carry is what's really key here in this learning session to go through, right? So let's just do a refresher on the core dynamics of the futures market. If you need a full refresher, there is the Understanding the Futures Market Part 1 and 2, which are great to reference here as well. But so when we think about it, as producers are selling our production to buyers, we know those buyers are hedging their purchases by selling the futures. So when you think if there's more selling activity on the futures, it's going to be pushing the price down, right? And so when that usually happens, that is when there's an ample supply market versus where the demand is. So let's think about this was the ample supply hits the market as we have here. So in a high production year, if you're a producer that sticks to, say, selling 20% of your crop at harvest, and let's just think the absolute number of bushels increases, right? So that would be more supply or product that's hitting the market that is prompting buyers to really ramp up that hedging activity, meaning they're selling more futures. And if there aren't people on the other side that are buying that, it's going to continue to push the price down. And on the other side, you can think about it, if there isn't that ample supply or you haven't had a bumper yield, but you're still selling 20%, that is an absolute less number of bushels that you'd be selling. But so as the demand of the pipeline gets saturated from more supply that's hitting the market, the buyers will have to start dropping their bids, right? So essentially they now need cheaper prices to justify overbuying more of this supply in the near term and carrying that extra product, right? So further, this hedge pressure is adding, or I should say, the additional hedge pressure is further adding to the price decline on it, right? And that creates that carry. So we have here that the carry becomes self-reinforcing, essentially. So without a carry, there is no incentive for a seller to hold the product long term. If we think about corn, say it's $4.50 against the December, and it's $4.50 against the March, $4.50 against the May, $4.50 against the July, etc. What incentive do you, as a producer or even as a commercial, have to be selling your product or buying more product in the nearby, right? Like you as a producer would want to sell more in the nearby because you're getting $4.50 no matter what. And if you carried it for another 6 months, you wouldn't be getting your costs covered. So without the carry, there's no incentive for the sellers to hold the product. And it's that theory of $1 today is worth more than $1 tomorrow. So everyone would end up selling immediately, and it would be flooding the stock, the spot market, and that's adding that hedge pressure, which eventually has that nearby futures price or nearby spot price move lower than the deferred, right? Which is ultimately widening the carry further out. So what is an inverse then? So an inverse is the opposite of a carry. That's where the nearby futures price or spot price is higher than the deferred price. And so this is a very interesting situation. And we have seen those in the past number of years, especially coming out of COVID. So it's a powerful signal from the market that the product is needed more urgently now. And that's the market willing to pay a premium to incentivize this immediate selling. So if you think about it here as a short supply would drive prices up, right? So inverses occur in the tight supply market. So when the supply is not able to meet the demand, buyers will end up competing aggressively to get the ownership that they can. And that's pushing nearby prices up above the deferred months as that urgency builds and they need to cover, or the focus is needing to cover more in the nearby to continue their operations. So also think about some interest rates and inflation. So low interest rates actually reduce the cost of producers to hold a product and sell, right? So that can tighten further supply. So if you are a producer and you look at it and say, it doesn't really cost me that much to carry product for another 3 or 6 months, that gets the market slightly more panicked in the sense that you can choose to sell whenever you want, and that they're not, essentially the market forces aren't going to incentivize you, right, to be selling something in the nearby. So that's where they end up pushing up the prices and trying to get what they can for their coverage nearby. So the high inflation will also prompt buyers to hold commodities, right, as it is a hedge against some rising costs, which is just further adding to that demand pressure. So there is the inverse relationship. So futures are inversely related to interest rate, right? So when rates are low, the opportunity cost of holding that physical inventory really drops, right? Going back to that example we just talked about, does it really matter if you have a really low cost to carry product 3 months or 6 months, right? Can you play the market better, right? So that just further amplifies what an inverse situation can get and really sustain that inverted market structure. So going through the dynamics here, how the inverses build the momentum and sustain themselves. So this is what's really interesting about inverses, and over the past number of years, probably like 4 or 5 years, we have seen that happen. So inverses become that self-fulfilling prophecy. Once the market tips into this inverse backwardation, a cascade of behaviors reinforces that structure and makes it very difficult to unwind. Once a market gets into an inverse, it can be very difficult to get out. So think about it. The buyers are scrambling for their supply. So if supply gets tight against what the demand is, buyers are going to flood to get their ownership needs. They want to reduce any physical risk or shortfall that they have, and at the same time want to be protecting any profitable operations. So what ends up happening is they're buying more, or they're out there buying the hedges, right? Futures to hedge against rising prices. So they're also buying the futures that pushes prices up. And we'll get into this in another video as well, but about delivery economics is they'll be buying those futures, right, as that hedge against rising prices and potentially having to take delivery. More adding to that demand pressure side and that self-fulfilling prophecy. So what also happens is sellers hold back. Producers will see that they're being paid more in the spot market, so they hold the product against the market's desperation. So what then happens in the inverse is there's less incentive for anyone to be selling in deferred periods, right? Because you look at it and say, well, there's an inverse now. Why wouldn't an inverse in the next period occur as well? So why would I sell something further out? So again, adding to that whole demand pressure and that self-fulfilling prophecy that's keeping that inverse market structured. The other one is really speculators, and this is an interesting one. So think about the other market participants of like hedge funds and index funds. Usually you can't say this for hedge funds, but indexes, they're long the nearby. So when you're in an inverse, they actually get paid to roll out to the next futures month. So think about it, if you're long a December corn at 450 and March is at 430, we'll say, so a 20-cent inverse, they can sell out at the 450 and buy the March at 430 and make 20 cents, right? So they sell out of the expensive nearby and buy that cheaper deferred contract, right? So in this profitable cycle will incentivize them to stay long, which is just adding and once again amplifying that inverse, making it difficult to get out until econs really break free, that nobody starts to see that incentive anymore. But that can be difficult, and that's why inverses can actually hold on for years. So the other side is the prophecy fulfills itself. So what happens is market panics. When you think about buyers and operations that are using your grains and oil seeds, is they have very expensive operations that they can't afford to be not running at any time. So they do not want to come up short on their raw inputs. So what happens is the buyers will keep bidding, sellers can keep holding, and the speculators just keep rolling. It creates that feedback loop that really sustains this inverse until there is that true economic fundamental shift in the supply and demand that breaks the cycle. So then you also have that behavioral side, right, which is this market panic. That is, we have to keep buying everything we can to make sure we have coverage, right? And as that demand, even if it's essentially false demand because it's just a behavioral thing, it still happens in the market that keeps that inverse really propped up. So that's diving in a little bit to the carries and the inverses with spreads. As always, I am Steven. You can contact me at steven@simplehedge.com. You can give us a call at our US or Canadian number. Feel free to provide any feedback or any type of discussions. And of course, follow us on our socials at X and Instagram below. Thanks very much.